Welcome to the deep dive. Today we're digging into something called Simplified Due Diligence, or SDD.
That's right.
In the anti-money laundering world, KYC and all that, it's basically a path for financial institutions to have slightly lighter requirements when a situation seems, well, lower risk.
Exactly.
We're using material from FinCrime intelligence today to really unpack this. We want to figure out when SDD is used, how it works, what its key features are.
And why it matters, right? That balance between convenience and security.
Precisely. It sounds simplified due diligence, but there are some important nuances, potential pitfalls even, that we really need to get into.
Absolutely. You can think of STD as, well, a more tailored way of checking customers and watching their transactions.
Yeah.
It only comes into play after a proper assessment suggests there's a lower chance of money laundering or terrorist financing.
So that initial risk check is fundamental.
Oh, absolutely key. It's the bedrock, really. You can't apply STD without it. It's not about cutting corners. It's about being proportionate to the assessed risk.
Okay, proportionate. So this lower risk idea, where do we actually see SDD being used? Can you give us some, real world examples?
Sure. FinCrime intelligence highlights a few common ones. Think about someone taking out an insurance policy with a really low premium or value.
Okay, like not $1 million policy.
Definitely not. Or maybe opening a very basic bank account, one where their identity's already been pretty well verified through other means, perhaps.
Right.
Another good example is those non-reloadable prepaid cards, the ones with strict caps on how much money can be put on them or spent.
Yeah. Gift cards and the like sometimes.
Kinda.
Yeah.
The idea is that the product itself, by its nature or limits, makes it less attractive, less useful for significant illicit activity.
Okay, so it's partly about the product, but what about the customer themselves? Are there certain types of customers who might qualify for SDD more easily?
Yes, definitely. Certain entities are often seen as inherently lower risk. Think government departments, public authorities.
Because they're already under scrutiny.
Exactly. And also regulated financial institutions themselves, like banks dealing with other banks.
Yep.
Plus, companies listed on major recognized stock exchanges often fit here too.
Okay.
But, and this is really critical even with these entities, you can't just assume. The institution must have done its homework. There needs to be a documented risk assessment justifying why SDD is appropriate in that specific case.
Got it. Document everything. So if the when and who line up for lower risk, what does SDD actually involve? How is it different day to day from standard customer due diligence CDD?
Well, the main differences are in the depth and how often you check things. With SDD, you'll typically do less extensive verification of the customer's identity.
Less paperwork, maybe.
Sometimes, yeah. Or less checking on the beneficial owner, the person who ultimately owns or controls the account. Transaction monitoring is also less frequent compared to standard CDD.
Okay.
And usually there's less digging into where the customer's money came from initially. Their source of funds or source of wealth.
Right. Less upfront scrutiny, less ongoing watching of every transaction. But the FinCrime material also says institutions still need to be vigilant. That sounds a bit contradictory. Less checking, but stay vigilant.
It does sound like it.
Yeah.
But it's about being smart, really.
Mm-hmm.
Proportionate, like we said. The routine checks are lighter, yes, but you still need systems in place to spot anomalies.
Like sudden changes?
Exactly. If a customer's behavior suddenly shifts or their transactions look weirdly different from their usual pattern, that should ring alarm bells.
Ah, so that's the trigger?
Right. That trigger could mean you need to bump them up to standard CDD or maybe even enhanced due diligence if it looks serious enough. SDD isn't set and forget. It's about having those tripwires.
Okay, that makes more sense. It's still risk-based.
Now, what about the regulators? Do banks just decide this for themselves, or is SDD part of the official rulebook?
Oh, it's definitely in the rulebook. SDD is recognized in major regulatory frameworks globally. The EU's anti-money laundering directives, for instance, specifically address it, and you find similar ideas elsewhere. So regulators expect to see it used correctly.
Absolutely. And they expect institutions using SDD to be able to show why they think it's appropriate. That justification has to lean heavily on that documented risk assessment we keep mentioning.
Right.
It also needs to factor in the nature of the product or service and any risks tied to the customer's location or the jurisdictions they're involved with.
And what happens if a bank gets it wrong? Say they use SDD when they really shouldn't have.
Well, the consequences can be pretty severe. If SDD is misapplied, especially if it involves a situation that later turns out to be high risk, you're looking at potentially hefty fines from regulators.
Ouch.
Yeah, and beyond the money, there's serious reputational damage too. Regulators don't take kindly to weak spots that criminals can exploit. It undermines the whole system.
Speaking of exploitation, the FinCrime materials do point out that SDD itself carries risks, right? What are the main worries there?
The big one is pretty obvious.
Hmm.
Criminals might deliberately seek out products or services where they know the checks are lighter, trying to fly under the radar.
Makes sense. Target the perceived weak link.
Exactly. Which is why that initial risk assessment has to be robust and why some level of ongoing monitoring, even if reduced, is still vital. You need to be able to spot those attempts.
So, what else?
Clear procedures are crucial. Staff need to know exactly when and how to escalate a customer's risk profile if something suspicious pops up. Move them from SDD to CDD or EDD. And maybe most importantly, proper training. Everyone needs to understand when SDD is okay and critically when it's absolutely not.
And the article was pretty clear on those absolutely not situations, wasn't it? Could you just remind us of those key red flags?
Yeah, there are definite no-go areas. SDD should never be applied to politically exposed persons' PPs.
Because of the corruption risk?
Precisely. Their position just inherently makes them higher risk. Also, no SDD for customers linked to high-risk third countries, those identified by bodies like the FATF. And finally, avoid SDD for any customer with really complex or opaque ownership structures. Lots of shell companies, hard to tell who's really in charge. That complexity itself is a red flag,
Right. So it really comes down to this balancing act, doesn't it? Trying to be efficient, offer a smoother experience for genuinely low-risk customers.
while still keeping the bad actors out.
Mm.
Yeah. How do institutions manage that tightrope walk effectively?
It's the core challenge. STD is great for efficiency. It lets banks focus their heavy-duty compliance resources,
Hmm?
the really deep checks, the intense monitoring on the areas that genuinely pose the highest risk.
Makes sense. Allocate resources smartly.
But it only works if that underlying risk assessment framework is solid. And the institution has to be agile, ready to react if monitoring flags something or if new threats emerge.
And technology plays a role here too, I imagine. Increasingly so, yes. Things like automated risk scoring tools can help make those initial assessments more consistent and data-driven. Real-time transaction monitoring, even if the thresholds are different for SDD, can help spot suspicious patterns faster than periodic manual reviews. Technology can definitely boost the effectiveness.
It's interesting how this fits into the bigger picture. The FinCrime intelligence trending now stuff talks about huge password leaks, AI being used by both sides, criminals and compliance teams.
Yeah, sophisticated phone scams too.
Right. All that stuff really drives home why even these simplified processes need to be built on a really strong, vigilant foundation. It's not about lowering security overall.
No, not at all. It's about being intelligent with where you apply the most stringent security. These wider trends show just how fast financial crime evolves.
Yeah, so criminals are always adapting.
Constantly. Which means even if a customer or product seems low risk today under SDD rules, institutions have to keep thinking about how criminals might exploit that process tomorrow, given these new tactics. Could that simple online account be used to launder proceeds from a sophisticated phishing scam? That's the kind of question they need to ask.
Okay, so let's try and wrap this up. It sounds like simplified due diligence isn't really about simplification in the sense of making things easy or less secure. It's more about targeted diligence.
That's a good way to put it. It's about making smart, risk-based decisions on where to focus your compliance energy.
It offers efficiency, yes, but only if it's built on that solid risk assessment, includes ongoing vigilance, and has clear triggers for escalating things when needed.
Exactly. It's that constant balancing act, access versus security. Simplified can't mean simplistic. The framework behind it has to be quite sophisticated, actually.
So here's something for you, our listeners, to think about. Given everything we've discussed, the evolving threats, the new technologies, how might our understanding of low risk itself need to change in the future? And how will that impact how SDD is applied? It's definitely something for institutions and even for us as individuals to consider. Thanks for taking this deep dive with us today.